Hey everybody, welcome back to the podcast. Today we have a really exciting episode. We're going to be going over dental practice financing. And I'm joined today by Lauren Camacho. So a little bit background about Lauren. She's the Vice President of Sales for Bank of America Practice Solutions. She leverages over a decade of experience supporting 1,000 plus offices and acquisitions in Central and South Texas. So Practice Solutions, it's a boutique division within Bank of America. They specialize in providing lending solutions within the dental industry. That includes business owners, associates, new dentists. But today we're excited to get her insight, talk about dental practice financing.
Yeah. Whenever I talk to clients, I always say the fact that, be bankable. That's one of the phrases that I learned very early on in my business career, be bankable. And what that really means is the fact that always be in a situation where your numbers and your situation look good to banks, and you're able to take advantage of deals, acquisitions, line of credits, whatsoever. But always make sure your business is in a situation where you're bankable, because bank can be your best friend, and they can get you through amazing opportunities, but also can get you through some rough patches. And so I know when we're looking talking to our clients, we're looking at their numbers and everything, we're always trying looking at how can these numbers look more bankable, and bankable basically means the fact that you could take your numbers today, tomorrow, 6 months from now, a year from now to a bank, and they're like, oh, these look great. What do you need? We're ready to work with you. Yeah. The worst situation could be the fact that if you're not bankable and you are knocking on doors and no one's opening those doors. Banking has one primary output, and which is cash flow. And cash flow, as we know, is the blood flow of a business. Yeah. And so if you're at a situation where you're not bankable, imagine is the fact that you're on the operating table and the doctor basically says we can't do a blood transfusion, right? Yeah. That's how serious it is. And so it's always important to understand that you have to be bankable. And I think the premise of this podcast and today's episode and the privilege that we have of having Lauren here today will be allowing us to talk about how do we become bankable. The how is the main question, and there's no really better than to talk to about than the individual that looks at 10,000 applications a year, right? That's kind of my 2 cents on today's episode. Yeah. Really excited.
Great point. And before we jump into the dental financing options, Lauren, I wanted to ask you a couple questions. I wanted to first ask you, so what steps do you think dentists should take to kind of be bank ready, 6 months in advance?
Yeah. So great question. Typically when we have new dentists coming out of school, right? They're coming out of school, they've got $400,000 in debt. They probably have a house. They probably have a car, maybe a couple grand in credit card debt, probably $5,000 to $10,000, and maybe $25,000, $30,000 in the bank, right? So that's all fine. One of the biggest questions that I get asked is always about student loans, and everybody's always worried. Is it okay if I have student loans? Yeah, absolutely, right? We expect you to. You just got through dental school. It's $400,000, right? It's not cheap anymore. So yeah, student loans are normal, but what the banks are typically going to be looking for is we want to see the 1 year of associating history. So you've been out and actually producing. Now that's going to be for general dentists. So if you're general, we're typically going to want to see about a year out and you've been working. Now, if you come out and you're out of residency and maybe you completed a specialty program, you can go immediately out of residency and start a practice or buy a practice. I would tell you that if you're gonna buy, it's probably good if you still go and associate unless you have some sort of production history, because as you know, when we're talking about, and we'll get into it later, I'm sure, the cash flow lending, the production piece is so important, right? You got to be able to show that you can take over what's happening doctor-wise in that office. Right. So that's one piece of it, your time license and your work history. We want to see that you're earning income. Typically, we want to see that you're earning north of $150,000 a year, which should be pretty simple. Most associates come out and they're going to be making $180,000, $200,000 if they're working full time and paid on production, hopefully, and paid a decent amount of production, because I know we've all seen it where it's like 25%. You're like, can we bump that up a little? Yay. So we're looking at that, and then obviously credit score is important, 700 plus. Don't go buy a Ferrari or your $1 million house just because you have that doctor's salary. Just try to keep everything like really lean and mean. So expenses to a minimum. If you're renting or you want to buy, don't buy something with a $5,000 mortgage. Try to keep it minimal. Car loans, like I said, don't go buy the Ferrari. And then cash on hand, and I'm sure you'll touch on this too, but cash is king. So typically, if you're going to start a practice, we're going to want to see $40,000 to $50,000 in the bank. And then if you're going to buy a practice, most banks are going to be looking for anywhere from 7 to 10% of the purchase price is typically what they'll be looking for.
Gotcha. And so these are obviously steps you could take to be ready. Now, in your expertise, what have you kind of seen the reasons why they might get rejected, whether that's for a startup or an acquisition?
Yeah.
Or what can you do to fix that?
Fix it, yeah. That's a great question. So if you're going a startup route with almost all lenders is going to be projection-based lending, because that's a $0 business on day one, right? Like you step into that, it's nothing. You have to build it. You got to ramp it up. So that's all projection-based lending. So I always say every bank is going to be different, right? And usually it's over the first like 3 to 4 years that they'll project it out and they'll say, hey, you're going to do X and up. Some banks may want a business plan from you. Some banks may not. So it just kind of depends. In those business plans, you may be required to do projections. I'm giving you a lot of detail here and some color. But all that to say, keeping the stuff minimal on the startup side is going to be super important. Your personal debt's minimal just because you're going to have some lower projection income, if you will, that has to carry that new monthly loan payment, right? And that's once you get to year 4, you're looking at $7,500 a month, maybe $10,000 a month, depending on how much you took out to do that startup, right? So you got to keep those personal monthly expenses low. One recommendation is probably keeping, and you may be against it, I'm not sure, but the income-based repayment on your student loans to have that lower monthly, or instead of aggressively paying that, right? Because we have some people that come out and are like, I'm going to go all in, I'm going to pay $5,000 a month on these and knock them out. It doesn't matter. Just let's keep the lowest monthly payments possible. So where we see those hiccups on the startup side is if we have them on standard repayment and we're paying $4,000 a month on student loans, or maybe we have a $3,000 mortgage, or we've got a $1,000 car and we have the credit card debt, right? So that's where we see some of the hiccups, or we just don't have enough cash. We got to just beef that cash up a little bit. So we have that rainy day fund if God forbid, like COVID happened again. Right?
Right. So do you have any specific ratios of DTIs that you guys look at?
We don't really look at DTI just because it's still going to be projection based. So we have that cash flow number that we're still looking at. Okay. But I like the number that I always like to see is like keep your personal debts between like $5,000 to $6,500 is usually a good round figure between like your mortgage, your student loans, your car payment or leases, and then credit cards. Just if you use them, just try to pay them off monthly. Like don't rack them up. I know like crap happens and you might have to, but.
So the numbers are on $5,000 to $6,000 of monthly debt repayments outside of your practice.
Correct. Okay. Yeah. And then, as we know, acquisitions are completely different.
Yeah.
Whole different animal. Those are all cash flow based lending. So that one's not as black and white as a startup. The best example that I always give to any new doctor that I'm talking to that wants to take out a loan is going to be, hey, if we were to go approve you for $1 million loan today.
Yeah.
If you come back 3 weeks later and you have a $300,000 loan, it may not cash flow, right? Just because, as you guys have seen, just looking at all the financials of every office, everybody runs everything different. And I'm sure doing the due diligence of offices, you're probably like, what the heck are you running through this practice, right? And so that bottom line number, it has to support the new monthly loan payment and then all of the personal monthly expenses. So that one's still cash flow driven. It's not a super black and white answer to really give, but it could be cash flow. It could be that maybe you don't have the 7 to 10% of the purchase price in cash. Maybe you have too much personal debt. Maybe it's production. You don't have the doctor production to take over the practice. And that's all of the students that I talk to. I'm always like, the day you sign your contract or before you sign that contract, you make sure you can get production reports, because the last thing you want to do is raise a red flag because you're coming back 8 months in. Now you're preparing to buy an office. You're like, hey, can I get my production reports? And they're like, why do you want them? And they're like, where are you going? So production reports are super key just to show that, hey, the office I'm looking at, I can take over that production. I don't have to hire someone to come in and make up that gap, right? I can only do 5, but this does 8. I don't need to pay someone to come in here and do the extra 3. I can do it all. I can do that $800,000.
Right.
So those are typically some things that I see as like cash or production capability or cash flow.
And there are some practices that from a banking perspective, you just can't put the loan on, right? Because sometimes they're too small.
Right.
Sometimes they're just too outdated,
and
it's just going to take too much to basically. Those deals we typically see are either cash deals or they're creative financing, you want to call it, right?
Yeah.
Can you touch on that a little bit and kind of like, what are some deals? We know obviously the $1 million practice that's doing whatever $250 EBITDA. whatever. It's all day, right?
Yep.
It's all day.
Easy.
Can you touch on some of the deals that you'll see come across your desk that are below average practices? Maybe the doctor got sick. They haven't been in the office producing. So it used to be $800 in our office. Now it's $300 in our office, right? Because he just isn't producing and he can't find someone to work there for him.
Yeah.
That's on the market, and because the price is attractive, people are looking to buy it. They can't get financing for it.
Yeah.
What are some of those offices that you guys kind of see, and where does that line kind of draw? Where it's like, hey, from not just from Bank of America, but from most banking perspective, this is too risky, and so these kind of offices will require some creative financing, which will not go through a typical lending platform.
Yeah, so there's a couple of those that I've seen where most lenders refer to them as like underperforming offices, right? Because they're declining revenues or just not where we would expect them to be.
Yeah.
So there's a couple models that some of the banks will use. It's called a jumpstart model.
Yeah.
Those would just be put back where we look at the revenues, we still get the tax returns, but ultimately we put those on projection-based lending as well. And we kind of run it as we would a startup, right? Like if you took this over today, the first year it did X, it's in the 350 the last year, then we'll just project it out again over the remaining 4 years and let's see how it produces or performs on that sort of same jumpstart model. Does it work? The other options where I see people go in those situations is to the SBA because they got the longer terms, which open up that cash flow. It gives that cash flow ability, right? You're talking 25 years versus conventional lending at 10 to 15. That's significant when you talk about cash flow ratios and ability to repay things. So those are typically the route that I see them go if we can't get them done conventionally.
When we talk about 10-year versus 15-year, who typically makes that decision? And the doctor able to basically say, hey, I want to do a 15-year versus 10-year, or does the bank basically say, no, for these kind of loans we're going to do 10-year, sorry, and these we can do 15-year. Who dictates the terms of the loan?
Great question. So most lenders are going to leave that up to the doctor, just because, as we all know, dentists are super, we all want to lend to them, right? They're super attractive from the lending side of things, right? We know their businesses are going to repay. They're good borrowers, right?
Yeah.
So when it comes to that, they typically leave it up to the doctor to make the decision. I would tell you, historically, we would see that doctors were taking that 10-year term, right? Just because any healthy, stable practice should be able to repay its debt over a 2-year period. Right. Nowadays, we see that more doctors are leaning into the 15-year, and that's just to open up the monthly cash flow. They want to make sure
the rates are higher a little bit.
Yeah, they might be a touch higher.
Yeah.
I mean, you're talking 5-10 basis points, and you and I both know 5-10 basis points is not that much money. If you're quarter point, if you're not even a quarter point can maybe swing at $100, but that's when you get to the whole half point, 3/4 point off of the difference, right? That's when maybe we'd talk about the difference of why you shouldn't take a 15 versus a 10 if it was that big. But you're talking, let's just say it was a 6% on a 10 versus a 6.10 on a 15. But it saves you $3,000 a month of cash flow. You know what I mean? So every lender will mostly build it to suit you. So you could say, hey, I want a 15, or I want a 12, or I want an 8. Maybe they're debt averse. Build it to suit you. If your cash flow supports it, absolutely, we can do it all day. But we've got to make sure those cash flow numbers are there to make sure you can repay it, because their best interest is our interest, right? We want them to be as successful because we want them to repay their loan, but we want them to also have a successful business as well.
And in today's lending relationship, the rate really isn't dictating the payment, but inflation is. Right. So where costs are a lot higher. It may make sense to do a 15-year while you get the practice, turn around, you get it where it needs to be. You get things figured out. Okay, well, you got the marketing figured out. You that learning curve, right?
Yep.
Where then you're really rocking and rolling. Where inflation is taking a big chunk out of that normally, and then you get a higher loan payment. It maybe makes sense to do a 15-year.
Well, and then maybe that's where you strategize with your CPA, right? And it's like, hey, I took a 15-year. I really want to pay it off in 10. And you work to accelerate the payment on it.
Right? So you first figure out, okay, well, how do I turn this practice to where it could be overperforming, all right? I mean, let me take that first 2 years to do that. I'm gonna have lower payments.
Yes.
And once I figured it out, and then I've got excess cash now because we're doing really well. We've got things figured out. The office is running, which is typically at that 18-month, 2-year mark. Yep. As you see that climb, now I have extra money. Now I can throw it towards the loan and get paid off.
You know what? You saying hey, having that runway, right? The nice part about startups is on startups, you're going to have that ramp up period, right? The first 4 years, which is how most banks are projecting you out. But for a lot of them are going to give you different structures on the front end to where your payments ramp up over time, which is super great. So you're going to see some that are interest only. You're going to see some that are some P&I, and it just keeps increasing the principal and P&I's principal interest, but the principal and interest amount over the first 4 years.
Yeah.
On the acquisition side of things too, I'm sure you've seen it. Some of the doctors, they want the little bit of a transition period, right? Lower payment and then going into the P&I. So even on acquisitions too, if it's helpful, we could still even do that 15-year term and pop in there 6 to 12 months of interest only. Most banks are willing to do that. So I think it's a matter of like figuring out that structure that's cohesive to what your financial goal is and what your goal is of the practice and where you want to get it to.
Yeah, and I think most doctors are really focused on the rate a lot, and then and the term a lot.
Yes.
When really you want to focus on the fact that what allows me to have the most flexibility in my cash flow.
Yes.
Because with inflation, you can't control inflation. It's there. It's going to continue to be there. It's going to continue to be a monster that chips away and it erodes your cash flow. Yeah. And if you're taking a hit on the payment side, then basically it's stifling the business, right? So we all know that once you get to a certain specific point and it's very successful, then you can make those extra payments and so forth.
That's right.
But when you try to get there and then you just keep getting hammered with inflation, get hammered with these things, and you just can't get above the wind current, right?
Yeah.
And that's the challenge. And I think that the question dentists should be asking themselves is the fact that understanding what their cash flow is going to look like in the next 3 to 4 years.
That's right.
Right? And focusing on, okay, what do I need to focus on? Right? What do I need to focus on to get me to where I can have a positive cash flow, 300, 400K cash flow. Once I'm there, then I focus on paying the debt down. But by trying to focus so much on the debt in the beginning, you're stifling the business.
That's right.
It's almost like a tech startup, right? Jeff Bezos made the funny comment on our Jay Leno show, like whatever, 15 years ago, where Jay Leno was like, so he's like, I every day I open up the news, whatever, I hear like Amazon lost more money this year versus last year, but your stock price keeps going up. Like, I don't know. I
don't understand.
Yeah. Explain to me in layman terms, what the heck am I looking at? And he's like, well, we're gaining momentum, and we're gonna have a point where basically it's gonna go with the curve, and at that point, then cash flow is gonna be immense.
Yeah.
Right. And so that's it's kind of like that kind of a business, right? Because you're going to expect to have cash flow crunches in the first
absolutely 12
months, 24 months, 36 months. So at that point, you want to conserve cash as much as possible.
Mm-hmm.
Yeah.
So great insight, both of you guys. Thank you so much. I think that was very valuable information. I want to jump now into kind of the different dental financing options. So the first dental financing option I want to talk about is going to be the bank loan. Now, the bank loan is probably going to be the most practical approach, for financing, as the dental industry is seen as a kind of a low risk by banks. Dental industry is obviously a great industry to be in, so you kind of lucked out there. The interest rates, when we're talking about interest rates, oftentimes those bank loans are going to be competitive rates. They'll have more favorable terms. So it's a good choice for those big purchases, buying a practice, doing a build out, renovations, moving to a high, traffic location, somewhere where you need a big lump sum of cash, right? Now, the big part of getting a bank loan is going to be the approval. That's going to be a little bit of the challenging part. And so some of the criteria is going to be, having a strong credit history, a well, prepared business plan, and then just adequate collateral, right?
Correct. It goes back to basically being bankable, right?
Yeah.
That's the terminology we're going to go back to. And if you have a good low amount of debt, if you have a strong credit history, if you don't have the Ferrari, right? When you're starting a business, starting a dental practice is starting a business, obviously, right? You always wake up one day and say, I'm going to start a business. You should know that's 12 months ago, 24 months ago. And you start basically putting yourself in a position. Same as you do with a house, right? When you're trying to get a house loan, what does the mortgage lender tell you? Hey, don't do any crazy purchases. Make sure everything's cleaned up. Make sure your credit card stuff is paid off, right? And so make that decision mentally 24 months before you want to do a startup or you want to do an acquisition or whatever, right? So if you're in dental school right now and say, hey, you're one of those really motivated doctors, and you're like, I'm gonna graduate, I'm gonna get 12 months under my belt, and then the moment it's like 12 months and one day, I'm gonna have an office, right? Okay, well you should be then in your fourth year in dental school, you should be start looking at your numbers and making sure the fact that start talking to banks already and saying, hey, take a look at my stuff. What do I need to do between now and 24 months to make sure the fact that I'm ready when it comes the right time, right?
Yeah.
Because business is about opportunity, and you don't want to be that individual that isn't able to take advantage of that specific opportunity because you weren't ready at that time. It might be that perfect location, it might be that corner location on a busy street,
right.
and but landlord's like, yeah, I need to sign a lease, this month. I got 500 doctors who are looking in the same suite. It's a busy location. You need to sign this, and we've seen deals fall apart because of that.
Well, and not only that, Omar, but like we'll have people that'll come to us and be like, hey, they want to talk to us, but they don't want to go through the process until they have, like, for a startup, for example, they don't want to go to the process until they have an LOI. And it's like, no, get your financing done, because as soon as you turn in an LOI, you're automatically more, I would say, like, leasable.
Yeah.
If you have your financing in place, because the landlord knows, hey, this guy's ready to go.
Yeah.
You know what I mean? Like, the bank will actually give them money versus the one that's like, okay, here's my LOI. And then that gets accepted, and now you're negotiating your lease, and now you're going to the bank for the loan. I have seen deals fall apart because unfortunately, they weren't ready.
Yeah,
they weren't.
It goes back to just do your homework, right?
Absolutely.
Just like when you're in school, look at your syllabus, know what tests and quizzes are coming on what days, right? This is a syllabus. Yeah. Quite frankly, this is a syllabus. So if you're not gonna be prepared to do those things, then the first step of your business ownership, you're putting at risk of sabotaging yourself, right? So you want to be looking at these things 24 minutes in advance, and because in business, opportunity doesn't time itself, and so that perfect location, that perfect lease, that perfect practice where a doctor may be giving it for a discount, but they're just like, I'm done, I want to get out, right? Yeah. And you've been working there as an associate for a year, and it's like perfect for you to go in there. Oh shoot, but my numbers don't look right.
Right.
And so the takeaway I'm going to say is the fact that if you want to be a business owner, as a dentist, you're a business owner, right? Do your homework, look at your prerequisites, make sure you talk to a bank, and you understand what they're looking for. You make sure you are bankable. Right. And then you sit there and you wait until the right opportunity, and then you pounce. Right?
Yeah.
But just like real estate deals, just like any other deals, if you start deciding that, I want to join the game now, when you see the deal in front of you,
right?
Guess what? There's 10 other people who did their homework before you. So if you come unprepared, to be harsh, you don't deserve the deal.
Right.
You shouldn't get it, because if you can't prepare yourself and organize yourself now, when you don't even have a practice, what kind of business owner are you?
How are you going to run a business?
What kind of business owner are you going to be? Are you going to be always running by the cuff, right? Or are you going to be someone that plans things out? It's a little harsh.
Yeah.
But
it's reality.
But it's reality, and business is harsh. You're taking on a $500,000 loan, $800,000 loan.
Yeah.
Right.
100%.
You better have the right mindset to do the right things and achieve.
You're just not gonna be able to sleep at night. That's the true reality of it. Is you're gonna go to bed worrying about how am I gonna make this loan payment, or how am I gonna do this. Like, the funniest thing, I have this conversation all the time of like, how do I hire and fire people? Like, because you go from literally being an associate to running a business, and now you got to make those business owner decisions. So it's hard if you're not preparing for the 12 months or 6 months.
And your first step of preparing is going to be the fact that, being able to, be bankable. That's it. That's the first step.
That term, they would start using more often.
Yeah. Good. Pay me royalties on it.
Royalties
I'll
forever.
expect
a market.
I'm a business person. I'm right at.
It's 75 cents every time Camacho says bankable.
I'll expect checks in my mailbox in the first of every month.
Perfect.
All right.
Know that my tallies will correct.
Passive income all the way, baby.
So earlier we asked your professional input on what a dentist should do 6 months before, and now you kind of briefly talked about the steps that they should take beforehand. So could you just outline kind of what steps you think a dentist should take, when they're ready now, right before, whether it's a startup loan or acquisition loan? And kind of mentioned, I know the LOI and that type of stuff, but just outline that.
Yeah, so if we know that you're bankable, right? Okay, there's your first 75 cents. Mark it down. I hope somebody's counting this.
I'll take it at lunch.
So if we know that you're bankable and we have that in line, right? If you're going to start looking for a startup, I would just say you want to start surrounding yourself with the right team, right? So you need to have your CPA, you got to have your attorney. Demographics is always a great thing to do, even if you're 12 months out, right? Because a lot of people are like, hey, I want to be here, right? I want to be in this. And then they actually run the demographics, or the realtor does it when they get closer, and it's like, oh, I actually don't want to be in that area. So like the steps to preparing yourself is truly surrounding yourself with the right team, making sure that you're checking all the bank boxes of what we need you to ideally look like, right? So again, that's 1 year license, that's earning 140 grand or more a year, that's good credit score, right? 700 plus is great. If you're a little under, it may not be a big deal. your cash on hand, 50,000 if you're starting, right? 7 to 10%, probably in that range if you're buying. I'm sure we'll get into it at some point because we've said real estate several times, but it's a little bit of a different animal when real estate's involved. But really just focusing on that and then production. But that team piece of having the right team is even more of how you're going to attribute your success when you actually open those doors or purchase that practice and make that transition into ownership.
I'll kind of comment on that because the team aspect, because me and Hamza are big basketball fans, right? They say, teams win championships. I do business though, right?
Yeah.
And in the business sense, and I've been an entrepreneur now for, I started when I was 14, so now what is that? I was 20 so odd years, 27 years, 25 years, right? All right. And so what I learned over my 25 years of starting doing business since I was 14 years old is that you don't know what you don't know.
That's right.
And so you can't read textbooks and read blogs and you can't absorb information just through that means.
Yeah.
Experience will always outweigh any literature, content that you consume, right? And so to have a team that your team should know more than you.
That's right. Absolutely.
Your team should be...
Because they're doing this for the first time, maybe, or the second time, right? And the team you're surrounding yourself with has hopefully done this hundreds of times and have seen it all, right? There's probably nothing any of us haven't seen at this point. And if we haven't seen it, we've seen some version of it and know how to get around it or fix it, right?
And so again, we go back to the entrepreneurial dentist, right? That you're not a dentist, you're an entrepreneur, you're a business person. And so the job of the most successful entrepreneurs, watch Shark Tank. What does Mark Cuban say? He says that I surround myself with people that are smarter than me. That's right. I don't
want to be the smartest person in the room.
You don't want to be the smartest person in the room because then that means you're leading that team. I mean, that's a lot of work to lead a team of people that you're paying, forward versus they should be leading you, right? And so they should be bringing things to the table. Hey, do this because I've seen this before. This because I've seen this before. Plan this way because I've seen this before. Yeah. The intricacies are in the details, the small details. And I can't overemphasize the fact that the mindset of an entrepreneurial dentist should be: step 1 is, plan yourself out. Step 2 is build the right team around yourself and understand that this team is what's going to get you to the finish line, not yourself individually. Yep. And that's simply because it has, since the dawn of time, experience has always outweighed, non-experience. And experience has always outweighed, just literature and what you could, content.
What content you can consume.
You could consume, right? Even myself, I'm part of multiple, advisory groups, right? And these entrepreneurs are, 10, 15 years older than me, right? But I consume things from them because they've, just like you can learn so much from your grandparents and, and so forth, right? Because they've been through life and they will give you gems. Yeah. It's not the quantity of the gems. Yeah. It's the quality of the gems. Imagine that one conversation you had with your grandparent, right? That one gem they dropped. Yeah. That one gem, the weight behind that one gem, right? The life lesson behind that one gem. You could talk to somebody for 2 weeks and it wouldn't outcome that because you just can't outweigh that experience. Yeah. And so you have to surround yourself with the right team from a business standpoint, which means the right bank, the right CPA, the right lawyer, and so forth, right? The real estate person. And then you have to surround yourself with the right team when you start the practice with the right coordinator and the right, hygienist and the right practice coordinator and so forth.
It's a continuous circle of building your team, right? You're always adding more and more experts.
The difference between selecting the right team and selecting a team is golden handcuffs. If you select a team, what happens? You bought yourself a job. Yeah. You bought yourself a job because that team will never be able to elevate itself to get you out. You will always be pulled into, if you're a regular banker versus a banker that specializes in this, you're going to be going to the fine point yourself. And you're going to find out things at the last moment. If you're working with a regular CPA versus double CPA, you're going to find things out on April 14th that you missed a specific, tax credit that relates to you, because you saw a YouTube video and then you're forwarding it to your CPA and saying, how come I'm not taking advantage of this, right? Yeah. If you're, working with the wrong lawyer and then something happens with your lease, you're going to find out much too late before you have to write a big check for your lease, right? So the difference between golden handcuffs and is the fact that a team that elevates you allows you to basically remove yourself from some aspects of the practice and some aspects of your day work and have a life.
Yeah.
A team that is just a team
Yeah.
will get 80% of the job done, but what is the weight of the 20%? What is the impact of the 20%? The 80-20 rule, right?
Right.
What is the impact on the 20% that gets missed? Which is then, if it gets missed, who is it on?
You.
It's on you.
Yep.
And then you basically have a dentist that after 4 or 5 years of practicing, I'm like, my God,
You're burnt out.
I'm burned out.
Yeah.
And between clinical, hiring, running a business, constantly putting out fires, I mean, like, I didn't think this is, I thought, like, I'm a freaking doctor.
Right.
I thought, like, your life would be better than this.
Yeah.
I'm exhausted, right? Well,
You can't wear 20 hats and be successful. I mean, you can, but you're going to be burnt out.
so what you did was you put scotch tapes,
Yeah.
right? I know we delve into this more than planned, but the importance of the right team has a ripple effect across success.
Yep.
And there's a difference between a job and a entrepreneurial dentist.
What type of acquisitions do you typically see banks shy away from?
Good question. Right now, I think that the big thing that we see as we see DSOs enter more and more and more into the space, right, and buying up these private practices, we've seen that some private doctors want to sell for that DSO figure, right? But they want that private buyer because they don't want some of those other requirements that DSOs have. So sometimes what we refer to that is loan to gross, right? So it's really the value, how they're valuing their practice. So if the practice did $1 million a year and they want $1.5 million, you're overvaluing the practice. So sometimes when we get to like, hey, you're overvalue, that can be a problem. It's some of those cash flow. Sometimes it's doctor production. I think we kind of alluded to a lot of it earlier, but the biggest ones that I see usually is the production base. Can you take it over? And then the valuation, since we're seeing it a little bit more and more. Typically we're seeing that practices are priced anywhere from like 75% to 95% of collections. Sometimes you'll see those upper echelon practices that are priced right at 100%, right? But that's really the broker's job. I always say, like, it's not the bank's job to value a practice. It's just not. Any bank would say, hey, that practice is worth this. It's like throwing a dart at a dartboard. Like, good luck hitting the bullseye, right? Like, we're not going to get it right. Like, that's what the broker's jobs are for. They're there to go through the numbers with a fine-tooth comb, pull out the demographics and the patient ratios and things of that nature that truly dictate that value and help you get there. The banks just have a figure of what they're comfortable lending on. And sometimes we'll see that sellers want a little bit more than that. In some cases, it's okay. But if you want working capital, you're not going to be asking for 100% of collections because you're not going to get it unless you've got the cash, and there's some doctors that have the cash that can carry their own working capital and just get the 100% financing on the note. But most doctors want 100% financing on the note for the purchase price plus your working capital, which drives up that ratio.
And for our dentists watching,
Yeah.
how long should they expect the closing process to take? Whether we're talking about an acquisition loan or a startup loan.
Okay, so two very different things. Acquisition loans, I would tell you post-approval, like once you get your approval from a bank, most of them are going to be able to close, I would say, within 45 days. It's really up to the buyer and the seller as to how quickly that moves. The only things that could typically hold it up is like a lien search or getting payoff letters from the seller. Or if you haven't turned in the conditions to the bank, that can slow things down too, because banks are gonna need some time to clear your conditions, create your loan documents, get those out to you. And then obviously they need executed docs from the seller, like the purchase and sale and the draft lease, and then your loan docs and insurances, things of that nature. So usually 45 days, I would say, or less. If you guys negotiate quick, great, we can close it pretty quick. If you have real estate involved, that's another animal. If there's real estate, I would say 60 days is what you're looking at. And then startup is a totally different beat. These are my favorite just because you're building your dream, right? This is your vision, your culture, you're building it from the ground up. So with a startup, most banks are gonna give you a construction period. So you'll get an approval. Your approval would be valid typically for 3 to 4 months. During that time, you're shopping for your space, you're negotiating on the place that you're gonna do this startup in. And then let's say, okay, I'm ready. We're gonna start construction. So that construction loan starts. I'm just gonna talk in regards to ours because I know our product, but every bank is a little bit different here on how long their construction period is. Ours would be 10 months. So you'd have 10 months to complete that construction period and get the office built out and your doors ready for opening. Now, where you're going to see differences across the industry is how your invoices are paid, your interest, if you have payments due during construction or you don't, things of that nature. So For our loan specifically, you would have your 10 months. You're not going to have any payments due. You're going to submit your invoices, and those are typically going to be paid within 24 to 48 hours. We require approval because we're not going to send, yes, it's our money, but it's your money, right? You got to pay it back. So we're going to get your approval before we pay any vendors. And then once you've made all your invoices, we paid all your invoices, you're ready to close, open the doors, you got your certificate of occupancy, then that's when your repayment will actually start. So again, that's where you'll see some differences. Some banks during that construction period, when you're just building up the office, they're going to want interest only payments. It's kind of like you're building a home, right? I don't love that model only from the standpoint of like, you've got cash already going out the door and you're not open yet. Not the greatest, but hey, if it's what you can get, it's what you can get, right? Yeah. So there's that. And then your payments would start, whether that, once that construction period's ended, if you have interest-only payments with your lender, your interest-only payments typically begin. Ours, you'd have your structured P&I payments that will go up year over year, essentially.
Right. And earlier you mentioned real estate. And so how does the bank kind of structure the loan then if real estate is included in the purchase?
Okay. You want both? You want startup and acquisition?
Yeah.
Okay. So if you're buying a practice, all of our loans, as I mentioned before, are going to be 100% conventional financing. Most banks are going to look to do that just because dentists are so lendable. So you're most likely going to get conventional lending. You'd have a loan for the acquisition of the practice, and then you'd have a separate loan for your real estate. Most banks nowadays are actually trying to get to 100% financing on the building purchase where you don't have to put any money down. A lot of times, though, that leans into, as I said earlier, how that practice is priced, right? You got to see if there's some equity left in there to kind of justify it. So you'd be looking at two separate loans. Both are typically going to be conventionally financed, 10 to 15 years. If you say, hey, I want to put 20% down on my building, great, we could do a 20-year term. That's where we also mentioned some doctors are like, hey, I just want the longer term. Maybe you buy the business on a conventional note and maybe you put the real estate on an SBA loan if you want that 25-year term, right? Maybe like a 504 or something. And then if you're doing a startup, typically most lenders on a startup, you'll have your startup note conventionally, and then you'll have your building purchase on an SBA loan, just because, again, that's a $0 business on day one. There's nothing to really, justify the real estate purchase versus a lease on a startup.
Yeah, 504, and we'll talk about it later on, is a great tool to get into the real estate aspect of your practice.
Yeah.
And then it opens up a lot of doors for the future, or say in the future you want to sell your practice, but you want to keep the real estate. There's so much flexibility there.
There is a lot of flexibility.
And then the tax benefits of it is a whole different animal. We've seen $100,000, $200,000, in your bank cash, IRS checks. Just being able to basically, use the real estate to accelerate your deduction and depreciation. And there's a lot you can do with it when you own the real estate and the practice together.
Yeah, sure.
I think that's a good segue to kind of talk about our next financing option, which would be SBA loans. Obviously Lauren and both Omar kind of mentioned about the SBA loans. So it's kind of, a lifeline for newer dental offices, because it's backed by the government. So lenders feel more confident, offering better terms. That could be like a lower down payment, right? Longer repayment schedules, like Lauren mentioned. So they're more favorable, right? Obviously for a new practice, that extra breathing room could be a game changer, right? While you're kind of getting acclimated. As I mentioned earlier with the, traditional bank loan, banks, dentists will often use SBA loans for bigger purchases, right? Again, real estate and things like that you just mentioned. Now, one thing I do want to mention to be prepared though is the application process does take quite a bit of time. So it requires a lot of paperwork. So this is kind of something like, as we've been kind of mentioning throughout this podcast, is you're trying to get ready, much more beforehand, right? This is not a last minute thing, but SBA could be a favorable loan, and it could be a smart move,
So the other aspect of SBA is the 504 loan. This is beneficial when you're buying the real estate with the practice. The way 504 loans work and the benefit behind it is the fact that one is you're able to get a lower down payment on the property versus a conventional. If you're going to get a real estate loan, you want 20% down, sometimes 25% down in today's market, right? With how real estate is. Yeah. In this scenario, you're typically able to get 10% down. Now, the way 504 loan works is the fact that there's two pieces to it. There's one is the bank portion, which is typically about 45%. It'll depend between 45 to 50% depending on the bank that you work with. And the other portion, another 45%, is the SBA bank, which will give you a 25-year term, right? At a fixed rate. So people had 504 loans 2 or 3 years ago, have a great advantage because, they were able to lock in, 3% loan for 25 years, where now late term rates are 8%.
That's my favorite question right
Yeah.
now. Like, hey, what's your rate? And it's like, oh, it's not 299 anymore. No, it's not 299 anymore. I wish it was.
Yeah.
I mean, shoot.
Yeah, so you have so thinking the real estate thing of it has two loans. There's one as a bank, which is giving you a regular loan, and it's taking 45%. So like say the property is $1 million, 450 grand is coming from the bank. That's a normal loan. Every 5 years the rate will reset, and then typically they'll have like a 10-year balloon or something, right? 10-year balloon basically means the fact that the entire loan needs to be refinanced after 10 years. The other 450K is coming from an SBA bank. That 450K is a fixed rate for 25 years. Now, SBA 504 loan is really beneficial if you believe the fact that the rates are going to not go down, right? So if we're talking 2 years ago, it's super beneficial because, you got a 504 loan at 3%, now the market's 8%, right? If we're at 8% and we feel that it's going to go back to 4%, then it may not make a lot of sense. But so there are things to think around it. The other thing is obviously it gives you a 25-year lock on 45% of it. Again, that's beneficial if you don't think the rates are going to go down. That's kind of like a crystal ball thing, right? The 504 loans for properties would be a no-brainer 3 years ago.
Yeah.
Right? But that's how the 504 loan works. It's only for owner-occupied property, being the fact that you are going to occupy, if I'm not mistaken,
I think it's 51%.
51%
right?
of the space you're going to occupy yourself. 49% could be another tenant, right?
Yeah.
And so that's how the 504 loan would work in conjunction with a conventional loan, where basically which is for the business. The business has its own loan.
Yep.
The property has its own loan, and the 504 structures it in that manner. So two big takeaways for the 504: longer payment period for 45% of it, fixed rate, and lower down payment versus in buying a typical property.
Yeah.
The rate and the fixed portion of it are as beneficial if you believe that the rates will
Stay
the same.
Yeah, stay the same.
Or go up.
Yeah.
Right. Yeah. Today's market, I don't see it going higher than where we currently are because of the inflation factor. Right.
Yeah. Fingers crossed.
Yeah. So I don't know if you have anything you would add to that or not, but I think that's kind of my spiel on how
I think I agree on all that. The only other time too that I see it is like if you have like a really large real estate amount, like some of these deals have like, especially in Austin.
Yeah.
Like, oh, $4 million for my building. I mean, and yes, we can do that conventionally, but you're talking on a 15-year term that impact to the cash flow could be a lot if it's not a really strong practice. So in those cases, it might be best to take the 25-year.
Less than 5% down.
Exactly. So we'll talk. I mean, every bank will talk through your options with you.
Yeah.
We feel like, hey, it's something you want to explore. I'd say just ask. No one's going to be like, no, I want to at least explain it to you, but let's explain the differences and why one would fit better than the other.
Yeah.
And then obviously, does it cost more money? Does it not cost more money? How does it affect payments, prepayments, all those things? Because every lender will be a shade different.
Yeah. Right. I think if I'm not mistaken, 504 loans have a little bit more fees on the front end.
They may, yeah.
Right.
Yeah.
So we wanted to kind of recap, why you might do one loan over the other, and I think those are both great inputs. The next kind of thing I wanted to talk about, and we're kind of going away from maybe big bank loans specifically, and that's going to be business line of credit. So that's kind of like a safety net for your dental practice, right? So it's there when you need it. You might have it there for kind of like maybe you're expecting a big purchase in the future, or you need an influx of cash, maybe slow months, if there's a down month, etc. Tackling small upgrades. So the good part of that is, of course you have interest on there, but only on the amount that you use. So you can kind of store it. It could be there as a safety net, as I mentioned earlier, but you don't have to worry about the interest on only the amount you use. So very, very cost effective for, I would say, short-term expenses.
Yeah. We don't see a lot of doctors, especially 1, 2 office locations, have a line of credit. My opinion on it is the fact that it's something you should have, just because it's a peace of mind, right? I mean, we have it for our business. I like knowing the fact that at any point in time, if I need to pull, money for a month, 6 months, 2 weeks, I have a place to pull it from, resolve a issue, and then move forward and pay it off, and call it a day. If there's short-term investments I want to do, if I want to bring on multiple associates that I know is going to impact cash flow, and I know the business is going to be there 6 months from now, and let's just say we don't have the liquidity for it, can you do so?
Yeah.
And when you start basically looking at the ROI on it, especially if you're doing things to enhance your business, right? Bring on associates, marketing, so forth, so on. The ROI on it is okay. You make 25 cents more on every dollar, but you're paying 8% of interest. The delta is what you're really making on that risk that you're taking, right?
Right.
That being said, it does not mean the fact that you're using line of credit, every month because your business is going downhill.
Right.
You're the same as a credit card debt, right? That's not what that's for. And if you should mentally know the fact that, hey, I'm in a trench, I'm in a rough spot right now, but I know the fact that
it's gonna come back on
3-4 months from now. We had a one-time situation. We had an associate that left. We had a disgruntled employee. We had our website crashed, we had issues with, whatever, insurance, switching, over insurances, and then to cause a cash flow issue, right? I have a short-term situation. I don't want to be stressed over it. I'll pull a line of credit, 20 grand, whatever, right? Fix the situation, pay it off, pay the $500,000 in interest, what I had to pay, call it a day, right? But it again, since cash flow is the lifeblood of business, man, you're on the operating table, you get blood transfusion,
it's there,
right? And so it's something that I think businesses kind of, especially in this current environment, should take advantage of.
I've seen it like back when COVID happened. I couldn't tell you how many people probably wished they had a line of credit, right? Because it was like waiting for those PPP loans or those idle loans. It was like pulling teeth, and you're waiting on the government at that point to give you your money. It's like waiting on your tax return.
Right.
When are you going to see it, right? So I would agree, it's probably a good thing. I see it a lot too in like the multi-practice space for the doctors who own more than 2, but maybe 4 or 5 or up in that range, higher amounts of practices, and then they're using those to pull the trigger fast on deals when they want to move. So I think there's a couple of ways that you could use it. You alluded to even like equipment purchases, even if it comes to year end and you're like, hey, I need to get this little piece of equipment in here for this extra op or whatever the case may be, because you need to grow. That's always a good place too if you don't want to have to go through the bank to get additional financing or the equipment vendor even. So I think there's plenty of ways, but just to your point, don't use it as a lifeline. Use it as like a resource when you actually need it to help in a spot of your business.
Correct.
Yeah, and I think a big theme of today is being prepared, right? Leveraging and being in the right situation. As Lauren mentioned, when COVID happened, people were wishing they had a line of credit. Like Omar mentioned, maybe you have a down period, but it's always being prepared. And I think that's kind of the big theme of today is we've talked about being ready, whether 6 months out, et cetera, right? So now the next 2 financing options I want to talk about are going to be a little bit more scenario based. So the next one is equipment financing. So maybe you're just looking to upgrade or purchase equipment only. You can kind of do equipment financing, which basically you're kind of using that piece of equipment as collateral. Now, equipment financing could be appealing for dental practices because the equipment itself is giving you the ROI, right? So I mean, you're financing the equipment, but it's helping you be more productive, right? Production's up, efficiency, things like that. So it's generating income from the equipment, and so that could be favorable if, in earlier situations we talked about big purchases, real estate, buying practices, but maybe you're just looking to buy equipment, so equipment financing can be favorable in that sense,
Yeah, and some of the creative ways that we've seen people buy practices that aren't bankable, right, where they're unable to get loans for it, using is, the working capital portion, they use their own funds, right?
Yep.
And the lease they'll transfer it to their name, and then to equip the practice, they'll use equipment loans, right? So equipment loans are a lot easier to get because it's backed by the equipment as collateral.
Yep.
And so we're talking about jumpstart practices where you have a practice that's maybe it's on sale for 150 grand, right?
Yeah.
And it's dead in the water, right? Yep. And then you would say, okay, well, no bank's got lend for it because it's the revenue's been going down every year. Doctor's been sick, he's had health issues, etc. You come in and so the way that you start getting creative is that you go in with the landlord, start with landlord and say, hey, let's negotiate new lease terms. The current tenants you have, they're on life support and they're going to leave any moment now.
Right.
If that tenant leaves, the value of your property is going to go down, right? Because your property is based off the rent collection, the rent roll, right?
Right.
And then good luck's going to find someone to go and take over this office as that, right?
Yep.
So let's negotiate and say, okay, you give me 6 months or 9 months of reduced lease terms.
Yeah.
I'll take over it.
They're gonna want to lease you anyway because you're a dentist.
Exactly. So first thing, you get the lease in order, right? And I think, cool, I got a lease in order now. The space is mine. Then you look at your personal savings or family savings for working capital because you're not gonna get that from a bank, right? So then you get the working capital, $100,000 of your own money to flow, right? Then you go to the equipment people and say, okay, I want to go to equipment. Let's do practice with XYZ stuff. They finance the equipment, and voila, you have a new office.
Right.
And you know with seeing people throw some paint on there, put in some tile work, right? Place the furniture.
Yeah.
And all of a sudden, for a much lower amount, they're able to turn this around. But that's creative financing.
Yeah.
Then that's what I mean by that. And so that's where equipment loans can come in handy. And when a practice is not bankable because of the current profile.
Yeah, and some of those situations too, some banks will be able to do some of it. It just may not be like, sometimes it'll be like, hey, I want to buy all this equipment in the practice, and they want like $600,000 for it, and it's just not worth that. Right. But if it's a reasonable amount and you're only buying the equipment, there may be certain situations where you can get the loan from the bank where you can do the equipment piece and then you'll have some working capital, but it's not going to be anywhere near the caliber of what you get for like a new startup, right? Of that $700,000 to $900,000 range of what you're getting for startup loans. So It's definitely going to be different. So having that backup option of like getting creative, how can I still get this if a traditional bank won't finance it? I think that's a great option.
And especially when you walk into this with this plan to the landlord and say, look, right now the office looks terrible.
Yeah.
Right? Here's what I'm going to do. I'm going to put new paint there. I'm going to put new tiles. I'm going to put new furniture. Or we're going to revamp this place. It's going to increase the value of your property too, right? There's more traffic here. So let's work together.
Yeah.
Right. And
sometimes they might even give you the tenant improvement allowance.
Yeah.
Which, if they do that, even better. You could use some of that to your advantage too.
Well, yeah. Right. So that's kind of where creative financing comes into play with equipment financing, personal savings, negotiating with a landlord.
Yep.
Those are ways to kind of like take over a lot of these smaller offices that we're seeing come up for sale now, especially rural areas.
Yeah.
Right.
Yeah.
Where they've been neglected, because of unfortunate situations with the existing owners.
Yeah. Yep.
Yeah.
Yeah, and then kind of the last, but not least thing I want to talk about is just personal savings, right? Or personal investments. The obvious pros of this is that you don't have a monthly payment, you're not paying interest. And so that can help you out as once you do get practice up and running, then, you don't have to worry about paying off debt.
Yeah.
So of course the con is that you're using your own personal money, obviously the risk factor and, the delay in getting your money back.
Right.
So that's kind of the last option. Like I mentioned, for these last two, they're more scenario based. If you're looking to buy a practice, build out a practice, obviously the first two options you mentioned probably going to be more your practical uses. But we wanted to talk about everything in a group sense. And so that kind of leads me to that was kind of our last, financing option. To kind of recap today's episode, we kind of talked about the different financing options. We talked about things that you should be doing much in advance, right? You don't want to wait to the last minute, whether that's you're buying a practice, you want to build out a practice, if that's your dream in a year, 2 years, you're graduating, dental school. As we discussed, it's always great to be well prepared. Things like line of credit and other types of financing, it's a safety net. So you don't want to worry about it when you're in danger, right? You want to have that much before. So I hope today's episode was very valuable, very insightful for the audience. If you're a dental practice owner or you're looking to buy a practice, build out, remember, we always advise, make sure you're talking to a tax professional, a banker, right? Yeah. To get the best advice. But as always, thank you for joining us today in today's episode. Lauren, thank you for joining us today.
Thank you for having me.
And have a great rest of your day.
And be bankable.
And be bankable. 75 cents.